Okay, so once again, good morning, everyone. I appreciate you being here today. Um, we are going to talk about hedging, using options to hedge. And we talk about this subject quite a little bit, but not really focused on just hedging. And so please feel free to ask your questions. If this feels overwhelming to you at first, just stick with it because it's one of those things that a lot of people don't think about. And you guys might be surprised to know that a guy that goes on television all the time talking about the evils of derivatives such as options, Warren Buffett, is one of the biggest option sellers in the world. He sells a lot of options, and he actually has option strategies that he uses to enter positions. He's a big option trader. He doesn't want too many people to know that, but he trades an awful lot of options. One of the biggest option sellers in the world. Okay? And you never hear about it. So why would Warren Buffett want to do that? Why would Warren Buffett want to use options at all? I mean, he's obviously well beyond the riches of everyone. It's not that he needs the money. Okay. That's right, Jerry. He's using it to bring and John, he's using it to bring in income and to minimize the risk of his positions because obviously he's holding some very large positions. So if we were to think about hedging and what it means to hedge, hedging is just simply a method of sheltering or insuring positions against overall all risk. And so many traders out there, when they think about the market, they only think of options as something to use for just wild speculation on trading. It's that's a common term when people talk about options, as people are speculating. But the true purpose of options, when they were originally created, they were created to allow the institutions to have a method of managing risk. Big institutions, if you can imagine having multi-billion and even trillion-dollar portfolios that they're managing all of this money, that's a tremendous amount of risk to hang out there with no way to really manage it. Because we all know how the market can shift and turn and stuff like that. They've got huge, massive positions out there that could be tremendously damaged if they didn't have a way of insuring or hedging themselves in those trades. Okay. And so options were really created truthfully for that reason, not so much for the speculation, but for the purposes of hedging your overall positions. So let's go ahead and go just a little bit further. When you think about a hedge, okay, what are we really talking about here? What's the most common method of hedging? Everyone in here does it. What's the most common method of hedging? Any guesses? Now, a lot of people would jump to that conclusion. How about setting a stop loss order? The most common method of hedging a position is to set a stop loss order. And we do that every day, right? We minimize the risk of the trade by evaluating that risk and setting an order to hedge us off, to prevent that risk from getting any larger, correct? And each and every one of us do that as a trader. We minimize that risk by using stops to protect ourselves or to hedge the position, to minimize the risk in the trade. And if you think about hedging with options in kind of the same method, it becomes a lot easier to get your head around it. Okay. When you think about what it takes to lower the risk of a trade, well, we use a stop loss to lower the risk of a trade every single day. But no one thinks about that as a hedge. But it truly is a hedge to that long position or short position, because we're protecting the bigger portion of that risk. Okay, does that make sense, guys? That's protecting that trade. All right, so if we can kind of think of hedging as essentially reducing risk, let's take just a real simple call option here, and let's run through a scenario here of hedging a call option. So we all know if we get into a call option, okay, the maximum risk in a call option trade is the amount we pay for the position. Okay, so a call option is already naturally hedged. If you buy the stock could go all the way to zero, right? But a call option is naturally hedged because we only have the long side of that position. So let's say, for example, we pay $5 a share for this call option. Okay. So we know on a one contract trade, our maximum risk in that position is $500. Okay. Not a big trick, right? We know that it has a upside potential that's potentially unlimited. Theoretically, the stock could go to infinity. So there's no upside potential cap on the trade in a standard call option. Okay, so our risk in this trade is $500. So we're going to do a little bit of math, real simple math. I'm going to make it real simple math. So if we were to take a look at a short call, we short an option contract, to short a call option, we know that our upside, this would be considered, if this was just a standalone position, it's considered a naked short. And what's our maximum risk in a naked short position? Yes, selling a call, a short call. When you sell an option, you're short that position. Tom, that's correct. If we buy a long call, we have an unlimited upside potential. Okay, if a stock can go up to infinity, if we sell a call option, the risk is the same to the upside on a short call. So this is considered a naked short position, is considered a very, very high risk position because it has an unlimited potential loss. What's the maximum profit of a short call? The maximum profit is the premium that you collect by selling the call option. Okay? That's right, the premium you collect. So if we sell this call option for $1, our maximum profit on this trade is $1 per share. Okay? But let's take this for a second and let's combine these two positions. If we take the long call and the short call and we put them together, the profile of the trade looks like this. Okay, now let's think about that. I know this one shows unlimited risk potential, right? This one shows unlimited profit potential. Okay, so if we have a position right here that has an unlimited profit potential, and then we sell something here that stops our upside potential in the trade, we've essentially placed a cap on the position. Okay, so a combined position looks like this. All right, so let's continue on with our math. We buy a position here for $500. It costs us $500. We collect $100. We can subtract $100 off of this position. What's our total risk in the trade? Total risk in the trade is now $400. We have reduced the risk of the trade by selling that call option against the short call against our long call position. Okay? Because we bring in money by selling that call option. Okay? We'll get to that, Kimberly. We'll get to that. If you're going to, I think you're going to have a minimum of a level 3, Kimberly, and a margin to count. If you want to do any spread trades at all, you will have to do that. Okay, and it's not hard to do. It's not a big issue. Okay, a lot of people fear it, but there's really nothing to fear here if you think about the math. Okay, so let me ask you, Kimberly, since you're on here, would you rather have a trade with $500 risk or have a trade with $400 risk? Yeah, that's pretty simple, right? We want to find a way to reduce our risk. We do that every day with a stop loss, right? We do that every day with a stop loss, but we never think about doing it this way to help reduce the risk of the trade. We can still have a stop loss on this. We can still have a stop loss on this entire position to reduce this risk even more, to hedge it even more. Okay, but it gives us an opportunity in the trade. That is correct, MB. Anytime you put on a trade like this, you also limit your upside. This is your cap. That's as far as your profit can go. Okay. Now, if you do this correctly, it's actually a good thing to do. Okay, and we'll talk about that as we go along here. How I do this and actually maximize the potential profit of the trade by using a hedge in the position. Okay, so that's just a simple way to hedge an overall trade, to reduce the risk. That's what we're all about here, right? We want to reduce the risk in a position when we fear a problem could occur. Okay, so hedging is very important. Just like any entry into any trade, the technical analysis is important and the timing is important, just like any other trade. Right? But it's not a mystical thing. It's not something that you should fear or be all worked up about so much, because it's actually fairly easy to do. Okay? And if you can think about it in that way, as thinking about your stop loss, you're using a stop loss to reduce the risk. Okay? By doing the selling the call option, you're also just reducing the risk of the trade. Okay. Well, let's think about that for a second here, HP. It all depends on how you lay that trade out. So, for example, if you bought this trade for $500 or $5 a share, okay, and we're going to go back here and say we sold this for $1 a share. If this is a $40 call right here, $40 call option, and this is a $50 call option, what's your potential profit in that trade? Well, 50 minus 40 is 10, right? $10. So we have, well, let's just do it at the actual numbers. You got a potential of $1,000 in between the strike that you buy and the strike that you sell. You collected an additional dollar here, so you collected an additional $100, which brings us up to $1,100. And all we have to do is subtract out the cost that it took to enter that original position, minus 600, excuse me, 500. Okay. And what's our profit in the trade? Okay. That equals our total gain. Yeah, Sean, you're correct. $600. That's that's the profit in that trade. Okay. So it's important with where you buy your option, right? It's also important where you sell your option. Let's go back and do that again. Would it make sense if this was a 40 strike option and we spend $500 to enter that trade? Okay. Would it make a lot of sense to sell a 42 strike option? And collect 50 cents? No, it wouldn't make a whole lot of sense, would it? I mean, it would work, but it doesn't make a lot of sense in doing that. There's not enough there to really make it worthwhile in the trade. So we have to think about how we enter this position. We have to enter these positions at the right time. We have to enter these positions at the right time as well. Okay, so let's move along here and let's talk about delta for just a second. Let's talk about delta. we always talk about the delta of our positions, but a lot of times folks don't consider what delta really means. We just know that Doug says somewhere between 70 and 80 deltas is where you need to be. Okay, but understanding delta is really, really important. Okay, and what delta really means in a position. So if you take a look at a hedge or hedging with delta, a lot of folks don't think about this or even know this, that if you own 100 shares of a stock, if you own 100 shares of Microsoft, you are long 100 deltas. Okay, each stock position that you hold carries a delta value. Okay, you own 50 shares of something, you have 50 long deltas. If you're short 50 shares of something, you have 50 negative deltas. Okay, and one contract, we know one contract of options is 100 shares, but that 100 share delta is split in two. There's 50 call deltas and there's 50 put deltas on that share of stock. Okay, on that 100 share position. Okay, so there's 50 call deltas and 50 put deltas. We essentially take in call option or in options, we split the stock trade in half, and we have the bullish side and the bearish side in the trade. So an at the money contract has 50 call deltas, and it has negative 50 put deltas. Okay, so if you buy a call option that has 50 positive deltas, and you buy a put option that has 50 negative deltas, what have you done? You have a neutral position. If the market rises, the calls will move up, and you'll lose money on this at pretty much an equal measure. Yeah, they call that delta neutral. But essentially, we've flattened the trade, right? If we're looking at a $30 call option and it's right at the money, and we buy a $30 call and we buy a $30 put, what have we done? Okay, think about that. We've flattened the deltas. So what does that mean if we flatten the deltas? If you buy a call option at the money and a put option at the money, you've created a synthetic position. We'll talk about that in a second. A synthetic position. Okay. And that is essentially a hedge. All right. So we can use options and combinations to try to offset risk, lower our risk, and even potentially increase the profit of a trade if done correctly. Okay. So one thing it's really critical that everyone remembers is that delta is the percent chance of an option being in the money at expiration. So what they do is they take the Black-Scholes or whatever model they're using to calculate options, and how option traders are trading those options determine the percentage chance of that option being in the money or out of the money at expiration. Okay? Actually, it's always in the money, the percentage chance of being in the money. Okay, so we know if we have a 70 delta option, okay, plus 70 deltas, we have an option that has, based on the mathematics, a 70% chance of being in the money. Okay, if we were to sell an option that has 30 deltas, okay, if it has 30 deltas, remember the percent chance of being in the money. This option only has a 30% chance of being in the money at expiration. So by thinking about our delta, we can actually hedge ourselves effectively, understanding our delta position overall. Okay? And being focused in on what that really means in the trade. So that's what we're doing all the time in these positions that we talk about. Now, by the way, if we take a look at our option chain, if we were to buy this option right here, okay, if we were to buy that option, 70 deltas long on the call option, we're paying $6.25. And if we were to sell this option right in here, about 30 deltas for $1.19, what's the risk in our trade? Well, we take this minus this. So we've immediately lowered the risk in our trade. Well, actually, minus that. We've lowered the risk in our trade by $1.15. Okay, so instead of $6.25 risk, we have $5.10 risk in the trade. Does that make sense, guys? we've lowered our overall risk. Now, here's the thing that someone NB was asking or something ahead of time. So what could we make in this trade? Well, remember what an option contract says. If we buy the option contract, we have the right, but not the obligation, to purchase the stock, okay, at the strike price within the specific period of time. Okay, so if we buy this option, we have the right to buy the stock at 243. Okay, if we sell this option, we're essentially capping our profits right here at 551. Okay, because we've given someone else the right to buy this stock from us at 251. Okay, now think about this for a second. Does anyone have a problem with buying a stock at 243 and selling it at 251? Does that sound like a good position? Isn't that what we try to do all the time? Buy low and sell high. But in using this option here, we have hedged our position. We have reduced our risk in the trade. Okay. John, you must have missed it. Why 30 deltas? 30 deltas. What's the percent chance of that option being in the money at expiration? %. So what does that mean? It also means that since we sold that position, there's a 70% chance that option will never be in the money and it will expire worthless. In our favor, we collect $1.15. If the stock never makes it to that price, it expires worthless. We still get to keep our long position in that situation, but we've collected an additional $1.15. If the stock happens to rise up to that point and go over it, by selling this call, we run the risk of being what they call exercised or called away on the trade. Well, think about the math there, Coach. What's the difference between 43 and 51? Remember your rights and obligations. This is where people get always messed up. We get all clogged up in rights and obligations. You have the right to buy the stock at 243. You've given someone the right to buy the stock from you at 251. Okay. So we have $8 potential profit in this, right? Plus our $1.15. So we have a potential of $9.15 in the trade minus what we paid to enter the position. $6.25. That's our gain. Okay. Now what I laid out right here, the idea of what I'm laying out right here is we're buying this option, we're selling this option. Okay. If you do that on the same contract month that we're doing here, this is a debit spread. That's all it is. It's a debit spread. Some will call it a diagonal, but it's a diagonal debit because it costs us to get into that trade. We have to pay something out to make this trade occur. That's why it's called a debit spread. Okay? But we have already hedged off $1.15 of the overall risk. Our maximum risk on this trade is 625 minus 115. So we've lowered the risk on the trade to $5.10. That's a hedge. Okay. And that's why you want to learn to do this. Okay. We'll keep getting into more detail here, but that's why you're going to want to learn to do this. By reducing the risk of the trade, you're effectively hedging off some of that risk and still making the trade an acceptable position. I use these options. I sell options at 30 deltas or less out of the money. Okay. I do that because, think about it. I do that because there's a lower probability of this being in the money at expiration. If I've done my technical analysis correctly, the stock is going to be moving up, but it may not move up that far. So I've hedged my trade. Now, what happens if the stock falls? What if I was just plain wrong and the stock falls? Well, first off, I've lowered my risk of my trade by $1.15. So I've lowered the risk of the trade already because I sold this. And if the stock were to fall, what could I do with this trade? First, it's hedging my fall off. I could just close it. This would be losing money. Gaining money in our favor. This would be gaining money in our favor. This would be losing money against us. So it hedges the loss. It decreases the potential loss in the trade. Okay, what I will typically do if I buy something like this and this stock just fails, plain fails, I'm just absolutely wrong on the trade. The first thing I will do is I will come in here and buy this contract and then sell this one. I've taken a debit spread and I've converted it to a credit spread. So I can now profit from this trade as the stock declines. Yeah, I still recommend you have a stop loss. That's right, MB. You should still have a stop loss to hedge the trade even more. Rob, C, yes, you can. You can sell weeklies against your monthly contract. That's called a calendar spread. Anytime you buy a contract and then sell a contract in a different month, that's considered a calendar spread, or some people will call them a diagonal because it's two different months. All right. But it's better represented by the term calendar spread because we're using two different months in the calendar, two different expiration periods in the trade. So yes, you can, and I do that quite often. You guys see me do that quite often. I will buy an option. Let's say I buy this option right now, and I'm looking at a May contract. The stock moves up for me like I want it to do, and I may come out here and sell this option, but I might sell this option in the Feb contracts or the March, whatever it is. I might sell the Feb. That has very little time to expiration, so that bleeds that trade out. Okay. Bill, yes, you can use options to hedge a physical gold position, but you have to really do the math on this. But yes, you certainly can. I do this, where I live. I have propane. That's what runs my house is propane. I watch the natural gas market and I hedge my doesn't need for natural gas or LP. I watch that market, and then I run hedges against that market to make money to pay for my propane. So you can, any commodity you could do that with. I mean, it's not a foreign concept at all. Farmers do that every single day. A farmer puts out a field, 20,000 acres. Okay. He has hundreds of thousands of dollars of risk in that. Okay. So what a farmer will always do is hedge the risk using options on the commodities market. They do it all the time. They hedge off that risk. It's too much risk. It's like buying insurance, guys. Okay? Everyone's comfortable with the concept of buying insurance to reduce risk. Okay? First, Rick, I never do anything naked. Well, in the stock market anyway. I don't do naked calls or puts. Yeah, I do naked charts. Okay. So let's say we want to hedge an entire portfolio. How can we hedge the entire portfolio? So we have this problem. We're holding a portfolio of long stock and positions, and they're doing well. We really don't want to let them go, but there's a potential out there in the market that the market could start moving lower. Okay? You add up all of your deltas. By the way, Thinkorswim does that for you automatically, guys. It adds up all your deltas. You have a 7,000 delta position, plus 7,000. What can you do to hedge off that risk? And I'm not talking about just one individual position now. I'm talking about the entire portfolio. Okay. Well, first thing we want to do, this is really important here, guys. When you think about hedging a portfolio, make sure you write this down or re-watch this and get this down. First thing you should do if you feel that the market's ready to roll over is consider taking some profits, right? Reducing your risk. Don't let greed get in the way of taking a profit. Take some profits out of the trade. Reduce the risk to the market pullback. All right? Then make sure your stop loss orders are properly set. Okay? If the market turns, we want to get out of those trades, right? So make sure those stop losses are properly set. Then you're going to determine the hedge size position. Okay? So I said you have 7,000 long deltas. Let's say we work at trying to hedge 20% of those long deltas. Okay, so what we would do is we would go into the market and we would look for put options. And the way I normally do it is I look for put options on what I believe to be the weakest index. So if that's IWM, I buy IWM puts. Okay, and I buy enough IWM puts to reduce my long deltas by 20% or 25%, whatever you prefer. Okay, to reduce my long deltas by 20%. So that means I would need to buy 1,400 negative deltas in puts. Okay, that reduces my long risk in the market by 20%. If the market does pull back, my short deltas are making money, my long deltas are losing money. Excuse me. If the market pulls back really, really hard, I'm losing money here, but my stop losses are tripping, reducing the risk. So my deltas are dropping, but my negative deltas are actually improving in value dramatically and increasing their delta position, hedging more and more of my portfolio. Okay. So like I said, what I normally do is I look to evaluate the four major indexes and I decide which one I believe is the weakest and the place where I can buy those put options to hedge the entire portfolio. Okay. And hedging anything, when you put on a hedge trade, don't think of it as a standard position. Okay. The reason you're putting on that hedge trade is to lower your overall long risk to the market. The weakest index is likely going to be the one that falls the first, Eva. Would you want to buy the strongest index? No. I look for what I consider to be the weakest of the index, the ones most likely to fall, to place my hedge. Okay. Looking to reduce my risk in the trade. Looking to reduce my overall risk of the position. Remember, anytime we buy an option position, think about the math here again, guys. I don't know, this confuses everybody, but it really shouldn't be that hard. Okay. When we buy an option position, just think about the math here for a second. If you're buying a delta position to hedge your trade, okay, and we know that delta also tells us how much profit there is in a position based on the delta, right? So would you rather get 70 cents per dollar decline or 30 cents per dollar decline? Okay. Right here. Coach, you're not paying attention. That was the first item in the list. Consider taking some profits. You don't know the market's going to fall, Coach. Let's use the current market condition. I've been saying I think the market's ready to roll over or very close to rolling over. Is there any clues in the market to that situation? Is there any signals in the market that says that we have to roll over other than like T2122? No. But you guys saw me go through this process this week. I closed positions and captured gains. I told you trades that I was going to hold through the weekend. And I told you that I picked up a couple of spread trades to hedge the overall portfolio. Stocks that I still wanted to hold. Because you and I both know, Coach, you're not all or nothing in the market. You're holding trades. Are you protecting those trades? Will a stop loss protect you in a trade if the market gaps 300 points tomorrow or on Monday? Probably not. A hedge will. A hedge will lower your risk, reduce the risk of your trade. That's why we hedge. Okay? That's why we hedge. Okay? Market falls. We're going to run through the scenario. Market falls. Your stops begin to trip, protecting your profits. stopping off some of those losses. Your overall delta is starting to diminish. Your positive delta is going down every time a stop loss trips. Okay? You have likely occurred some capital losses in those trades, right? When that occurs. The negative delta position is increasing in value. The puts are going deeper into the money, and your delta position is increasing on your negative position. So you likely have capital increases going on in this trade. Does that hedge the losses? Yes. If the market continues, the hedge is growing in percentage. More and more of the trade is being covered. So for example, let's say that 7,000 position, you had 7,000 delta position, you had stop losses trip out. Now you've only got 5,000 long deltas because your stop losses did the job, taking you out of those trades. You've reduced your overall long delta position, and your negative delta position is growing because as the market falls, this negative delta is growing, and now you have more like a 45% hedge on your long deltas. Instead of 20%. Yes, you can hedge using anything, Kimberly. You can hedge against the individual stock itself. You can hedge the entire portfolio. Okay? So you can rest a little bit easier here because you have a plan to protect your downside risk. You're reducing the risk. And by the way, this is for anybody out there that's going, this just sounds too tough, too complicated, too everything. Guys, the rich guys in the world, they do this all the time. This is what they do. This is the purpose for options. Don't just push this off and say, I would just sell. No, you won't. You know that. Look at your win-loss ratio in your portfolio. You didn't sell. That's how you get losses. All I'm talking about doing is reducing the risk of those losses. Finding a way to prevent those losses from being so big. Don't write this off as saying, well, that's just, I don't have to do that. Look at your win-loss ratio. Look at your portfolio. Look at your profit. Is it growing like you want it to grow? Would it grow more if you reduce the risk in the trade? Institutions do this. Warren Buffett does this. Don't write this off as, this is too tough or too complicated, because it's not. All right? We're just looking for ways to reduce the risk of our trade. And what's great about using option hedging is we can actually improve the profits of our trade by doing it. Okay? So don't ignore this stuff. Market goes up. Market starts to rise. Okay? Instead of going down. The long stock holdings continue to move higher. Your likely capital increases in your long deltas, because remember, you're 80% long. You've only got a 20% hedge. So your overall portfolio is increasing in profits. If you're wrong on the hedge, your negative delta positions, you're going to start losing money. And you're short 20% on this trade. And your delta positions here will start to diminish. Your negative delta positions will start to sink. Okay? But remember, it's only 20%, so it's just an insurance policy against what you thought might have been a big move down. So you've got an increase here, a decrease here. All right? And if the price action of the chart begins to confirm that the bulls remain in control, just close your insurance policy. That's all you got to do, right? Close the insurance policy. Don't need it anymore. You were wrong. The market wanted to go up. Yes, T, if you did that as an individual position, okay, you got stopped out of the stock but didn't have any kind of a stop on the overall trade, you would end up being naked short a position. You'd get a unless it's a cash position with enough money, you'd be getting some warning calls from the broker real quick. Okay, so what do? Think about that for a second. We don't have to sell these orders individually. We can, but we don't have to. You can place a stop loss to sell the entire position. Okay? We all know that debit spread trade, we can sell it with one order. Close the entire trade. Then you have no problem with being naked in the position. Okay, combine the positions. Sell them as one. I mean, I do that all the time. Same way, an option is an option. Price action is price action, Bill. If you can learn to read price action, it doesn't matter if you're trading currencies or if you're trading commodities or if you're trading binary options. If you can read price action, price action is price action. And the strategy of reducing risk works exactly the same way on everything that you trade. Okay? So it works on anything in a position. So let's take a look. Let's bring up Thinkorswim here for a second. And let's take a look at this. If I were to go in, well, here, let me just show you guys that diamonds. I'm going to go the diamonds. I'm going to go the February contracts. You guys know I carried long risk into the weekend. Okay? I had long risk because I bought. I still own SQ. I still own VIPS, and what else? I still own Citibank. Okay. So I carried that risk into the weekend. To hedge that risk, I went into the diamonds. I went out here. I sold a contract around 30 deltas. Okay. I think, honestly, I think I'm in this one because the market moved up a little bit since I sold it. I can't remember for sure. No, I think it's here. 243, 244. 253 and 254. I'm pretty sure it is. So I'm short this one and I'm long this one. Okay. So I collected a premium on the trade. Yeah, 253, 254. That's the one I'm in. Now, when you look at the delta position, what's my delta position on this? If I'm long this contract, I have 29 deltas, right? But on this one, I'm short. So subtract 35 deltas. What have I got there in that trade? I have a delta negative position. I've reduced my delta of my portfolio by putting on that spread. Now, why did I just use a spread? I used a spread because there's absolutely no price action clues in the market that says that the market has to fall. So what I did is I looked at the market and said I found some resistance up here, and so I put on a trade that could reduce my risk. Now, you saw that trade. I put on this trade for like 31 cents. So 10 contracts. What's 10 contracts going to mean to me? 310 bucks. Okay. 310 bucks is a very small hedge. It's a small hedge here, but I'm only carrying 3 positions. If the market falls, I stand to make a possible $300 on that trade, reducing the losses that I might take if the market does roll over. Okay. Fidel, look at the price action chart. Just like any price action chart, where would you want to place a stop around any trade? Look at the price action, say, you know, if it crosses back above here, I no longer want it. I was wrong on the direction, close the trade. Don't make this so hard. Most hedge trades, guys, I'm going to do for a short duration. Yeah, this is a bear call spread. Bear call credit spread. Okay, and I put that out in the room. I showed everybody that I was doing it. It's a short duration trade. There's only 13 days left in these options. Okay, these options will have to be at 0 at expiration if they are still out of the money. I make $310. Okay, but if the market on Monday shoots up and breaks through resistance above and just looks like it's going to continue to go up, well, I was wrong on direction. I close this trade. I'm going to take a small loss here, but my long positions are probably making money. All I did was hedge the risk. If the market falls on Monday, the long stocks that I'm in are likely going to decrease in value. This is going to increase in value. I've hedged the price action. That's right, Thomas. Just place a conditional order to sell the close the position. Moves above a specific price, close the trade. Kimberly, hedging around an earnings event is a little bit different animal. Okay? And we've talked about that before, hedging around an earnings event. And the reason it's a little bit of a different animal is because you really have the massive implied volatility change. And I'm going to tell you that unless you had a nice profit in Amazon, trying to play the earnings was just a gamble. And I'm going to tell you every single time, don't do that. There's no need to take that kind of risk in a trade. Okay, good. There's no need to take that kind of risk in a trade on an unknown event. That's not who we are. We're not gamblers. We're traders. We're here to make money. The price action of the chart, Bill. Sorry, I guess I'm getting a little frustrated here because we talk about this stuff every day. Where should your stop loss be? Where would you be wrong on the diamond hedge? Where would you close this trade? Think about it for a second. Where would you close that trade? If this put in a bullish candle and popped above Friday's high, would you still want that hedge trade for a short? No. stock's moving up, it's likely to attack the next level of resistance up here. Why would I want to continue to hold that short position? Stop yourself out. Get out of that trade. Your long trade should be making money if that's going on. Right? The long trades that we're holding are going up with the market. So just close this part of the position. CJ, if you're talking about legging in and legging out of a debit credit spreads and stuff like that, you can certainly do that, but that's not the topic today. That's a bit more advanced. We're struggling right now with how to place a stop loss here, so I'm not going to get into legging in and out of the money trades. I don't always hold my hedge over the weekend, no. But you guys see me hedge all the time in a trade. Okay. I hedge all the time in a trade. We bought JD right here. Okay, so what happened in this trade? Stock moved up. Okay. I took partial profits on the trade this day, right here. I told everybody what I was doing. I took partial profits on the trade, and then I sold the 26 calls, bringing in premium. Okay? The stock pulled back. I kept telling everybody, I'm not stopped out. I'm not stopped out. I'm not stopped out. Everybody asks me every day, are you still in the trade? Yes, I'm still in the trade. I took some profits. I kept my stop loss here because I hedged the position, the remaining position. The stock pulls back. I'm losing money on this long call, right? This long call is going down. This is going up. I'm gaining money here. All of that time that passed between here and here, this option, because it's a shorter term option, is losing value because of theta decay. Losing value every day. The short option. It rose back up here to my target. You guys remember my target was 25 on the trade. I closed the entire position. But I never had to sweat the trade because I'm hedging. I'm reducing the risk of the trade, and I'm using the price action of the chart to help me do that. Okay, using the price action of the chart to help me do that. I buy at support. I look at selling near resistance or adding that short hedge. As the stock moves up to that hedge, these options up here gain value, making them more acceptable to sell. I make more money by selling them after I let the market move that stock up. Okay, so that's hedging an individual position. Okay, pretty simple. I let the stock, I buy the right entry signal, I allow the stock to move, and then I sell the hedge to reduce the risk of the trade. I've reduced it first by closing part of the position for a profit, and then I reduce it further by collecting premium here. Making some sense? Now, if I'm going to hedge my overall portfolio rather than just an individual position, then what I'm going to do is I'm going to look at my deltas. If you look at Thinkorswim, and I only have this trade on right here, delta can be right here on your screen. Notice that this ratio spread that we have in here on MU, I believe it is, or excuse me, AMD. On this AMD trade, our delta position in this trade is only 27.80. So I have 27 long deltas. How could I only have 27 long deltas in this trade? Well, if we look at the trade itself, what do we have in the position? We have this delta here that we sold. Okay, so we have 42 deltas here. We have this delta here that we bought. Okay, so what's our delta position in this trade? Our delta position is 27.80. So we sold two of that smaller one. Excuse me, bought two of that smaller one, and we reduced our overall delta position in the trade. That's why the ratio trade is naturally hedged. If the stock moves up, we make money in this trade. If the stock moves down significantly, we make money in this trade. Okay. But if I were looking at this position here, and we have a bunch of positions, and my delta, let's say my delta is just 1,000 deltas. If I have 1,000 deltas in this trade and I'm worried about the market starting to roll over, I'm going to go through that process. Is there anything in here where I should just be taking profits on? Step one, should I be taking profits on some of these trades? Step two, what am I going to do? Step two, I'm going to evaluate my stop losses on the positions I decide to hold. Make sure they're set properly. Step three, I'm going to look at the indexes and see which one of the indexes looks to be the weakest on the price pattern itself. And I will pick up negative deltas to offset this trade. So if I want to set 20% of this long delta position off, I need to buy 200 negative deltas, or somewhere right around that. 200 negative deltas, and that lowers the risk of my long deltas by 20%. This making some sense? Okay. Well, and Bal, the reason I do that is I'm doing the work, right? We're doing the technical analysis. So as long as we're not doing something stupid, okay, and just blindly throwing money at the market, we're looking at good trade entries, right? Good quality trade entries. That's what we're looking for in trades. So let's take this, well, that wouldn't be a very good one to give an example of. Let's take a look at MU. Okay. Let's say you enter this trade here on MU. Okay. MU is a pretty good entry point on Friday, right? Looks pretty good. Still has the potential that it can move over toward the trend. So it may be early into the trade, but it has that potential to move over. By the way, here's a great example of that right here. Pull back, hit the trend, move up, and what did it do? It still moved over to the trend. Okay, come back and moved over to the trend. That happens a lot. Okay, so this possibility that could move over here. So as this moves up, if you see this is obviously a resistance point in the chart, right? Obviously, as a resistance point, you could say that's my target. I wouldn't on this. I believe in this trend. I believe in the downtrend has been broken and that the uptrend is in play here. So if I were going to be in this trade, I would make the assumption that this will eventually break. It may require this to move up and consolidate over to trend to break it. But as long as it holds this trend, I'm okay with that. Okay. So I'd be looking at resistance targets higher than that, maybe up into here. Okay. On that trade. If the stock moves up, does what I want it to do, moves on up, once I start reaching that resistance point, I'm going to look for an option contract out here, out of the money, to sell, so I can bring in some premium. I will probably look at closing part of the trade to collect profits as well, reducing my risk in the trade, right? I may put profits in the account, reduce the risk of the trade, then sell a call option to reduce the risk in the trade. Because what do we know about the way a chart moves? It moves up toward resistance, and most of the time pulls back, backfills, comes back to the trend. So if this were to just move right on up into here, what is the possibility that this pulls back or comes back over to the trend before it continues going up? So I can stay in this position. Let's say this is a May contract here. Okay. And this is a March contract here. I sold a March. So the stock moves up. I have plenty of time for this to pull back, consolidate, whatever. This is making me money. Why I'm losing a little bit here on the pullback and the time, this is offsetting that trade. If the stock finds support, shows a good buy signal, I close this trade, take my profit, and allow this trade to continue to make me money to move up to the next level of resistance. Okay? Just hedging those positions. Okay? If this trade moves up and then just absolutely fails, just drops, okay, I have to close this long trade. I'm still okay because I did take a profit here in the trade. Close this long trade to stop the loss. I turn this one into a bear call credit spread so that I can make money up here. I know the direction of this market now, direction of the stock, so now I can make back anything I lost here. Not all of it sometimes, but I can make back some of what I lost in that trade that failed and stopped me out. I can make some of that back by just leaving this, turning that into a credit spread, letting this expire worthless for a full gain. Okay, is that making sense? So think about the way you do that. Here's an old trade. I'm going to give you guys an example of that. This was just one that just turned out really, really good. Really, really good. And it's pretty easy to understand. Okay. So right way options, we got into Valero Energy. And I can't remember if it was down here or up here. I want to say it was probably out of this little pop out of the box. Same pattern I always trade. So we got into a 70 plus delta option. Okay, 70 plus deltas, and bought long calls here. The stock started moving up for us, and it just kept moving up and moving up and moving up. I suggested taking some profits. And as we got up into here, we were getting close to 100. I told everyone what I would recommend you do is to sell the 100 call. So the 100 strike call, we sold I can't write with this thing. We sold and brought in a premium. Okay, so we've already captured capital here. We've made money on the original trade, captured money. Stock rallied up toward 100. 100 is a natural resistance point for a stock. It rose up there, and we were actually down on the call option that we sold. We were losing money on that. but we were making money on the long call. Okay. So two things could have happened here. The stock could have went above 100 and we get called away at 100, which no one had a problem. Take it at 100. I'd be glad to sell it at 100. Or the stock could fall back again. And that's what happened. The stock fell back. And right here on this candle, on that failure, I told everyone to buy the 105 calls. To buy 105 calls, creating a credit spread, and then close our original long trade. Okay, so on the way up, we made 140% on our long position. Our long position made 140%. Okay, that's our long call. Our short spread made 100%. Because the stock fell below 100, stayed below 100, this expired worthless, we made 100% on that trade. Okay. Make sense? Use the price action of the chart. The price is giving us clues, and we know how to, if we know how to use options to reduce the risk or manipulate that price action to our favor, then we get the benefit of doing that. And when you start understanding that options are more than just a speculation tool, okay, this drives me crazy. People think options are just, you know, it's the get rich quick plan. You don't have to professionally trade. It's just a get rich quick plan. You see it all over the internet. You get it in your email every single week. Somebody's just showing you some get rich quick plan and options. Options aren't that. They never have been, and they were never intended for that. Options were intended as a method of reducing risk and hedging positions. So if you can learn to work with those option positions and work through those hedges, you can make tremendous amounts of money doing it and reduce the stress that you have in your trading. Okay, now I'm going to recommend, and I'm going to spend just a tiny little bit of time before we finish up here on this Analyze tab. And the reason I want to do that is to show you what you can do with this Analyze tab to give you an idea on how you can work with the position and see what that's going to do to reduce the risk of a trade. I'm going to use MU as an example. And the reason is because there's that buy signal on MU. I'm going to go to MU, and let's say that you came out here. Let's look at the April contracts. April contracts look pretty good in here. April 35s. Person could have bought this April 35 call. Okay. Now, if we buy that April 35 call, hopefully we'll catch it down here around $6.50 or something like that. But we know we've taken $650 risk in the trade. We know by looking at the chart on MU, we're going to place a stop loss, right? If the stock were to fail back down below this support area, we no longer want this trade, right? So we'd have a stop loss in there automatically to reduce the risk of this trade. All right. Here, I'm going to go over to the simulated here. Do that same position on simulated. Okay. So we have this position. If we take a look at the analyze on this trade, we can look at the risk profile of the trade. It's just exactly what I showed you what a call option was in the presentation. Okay, call option has a maximum risk, $655. That's what we've put into the trade. That's the maximum we risk. If we place a stop loss on that trade, obviously that reduces the risk in the position. Okay. But if we were to do something like this, let's go from April let's go to a shorter term time frame. Let's look at March contracts. Find an option that's out of the money. Probably this one here, out of the money. Sell this option. Now let's go back and look at the risk profile of the trade. First off, our risk, our maximum risk in the trade has been diminished. We're now, here, let me shrink this up a little bit. Now our maximum risk in the trade is $546. Okay, we went from $655 risk to $546 risk in this trade. We've reduced the maximum risk of this trade by selling that call option and bringing in that premium. So not only do we have a stop loss, we've overall hedged the position and lowered the potential risk of the trade. So let's talk about this trade here for a second. What are the rights and obligations of this trade? We have the right to buy the stock at 35, right? That's all right. We can buy the stock at 35. We can sell the stock, or we've given someone the right to buy it from us at 43. So what's our potential profit there? Potential profit between those two is $8, right? So we have an $800 potential gain in this trade. All right. That's our maximum potential on this position. What was our cost of entering this trade? Our cost of entering this trade is $653. If my math is right, and change, 653 and change. So our maximum profit on this current trade is 147. Now 147 would be if the stock rallied right up there to 43 and we got called away on the trade. Okay? I combined, whoops, sorry, I did that wrong. Sorry, the cost of our trade is 546. I knew that didn't seem right off, but 546. 546 is our cost in the trade because we spent 650, we collected 109. So that's our cost in the trade. That means our potential profit is that 800 minus 546, which is 254. The $254 is what we would make on this trade if the stock did exactly this. We bought this trade right and it moves straight up to $43 and we get called away. That's what we would make on that trade. All right. But what if the stock doesn't go up to 43? Well, yeah, your max profit. Just look at if you use your Analyze tab over here, see this bottom corner over here? The blue line is expiration, okay? So our max loss on this trade is $546. What's our max profit on the trade? Move up here, $258. Okay. And B, if you want to sell one in February, sell one in February. Just know that when you sell one really close in time, you're going to make very little money in the trade and you're likely going to be closer to the profit. Okay? There may not be enough premium to make it worthwhile doing, and it'll be too close to your entry position to make it worthwhile. You'll have to evaluate that. I just went with the March because the March is kind of my rule. When I'm selling calls, I want to sell, or selling options, I want to have somewhere between 45 and 30 days to expiration. That gives me enough premium to make it worthwhile. It usually gets me far enough away from my position to make money. Okay. So in this case, I lowered the risk of the trade by selling that call option. Now I'm showing you this as if I just did those at the same time. Okay, I don't want to do these most of the time at the same time. I'm going to buy the first option. I'm going to let the stock move up, and then I'm going to try and sell an option. So I let the stock move up, I take some profits, and then I might sell an option. It might be up here around 45 that I can actually sell that 30 delta option now, giving me more potential profit in the trade if the stock does continue to move up. Like I showed you, rarely do I do a straight up debit spread at the beginning, because if I'm doing the technical analysis, if I'm doing the work, I may as well take advantage of that work and let the stock move in the direction I'm expecting it to move in, then sell the option to collect more premium and get farther away. Because if I can sell the 45 rather than the 43, obviously I've given myself $200 more, $200 more of potential profit in the trade. Instead of 245 or whatever that was, 285 in the trade that we had, we've raised that now to 485. Does that make sense? Legging into the trade. I've already committed to the longer position because I bought April. I may as well let the stock do what it wants to do and continue moving in its trend. I have plenty of time to do that. Let's take advantage of it and make more money on the trade. Hey, that's awesome, Glenn. That's awesome. So let's take these options and let's throw on the theoretical price model here. Stock is currently at 39. Let's move this up. Let's move this stock up by $3. Okay. So we're up here in this $42 price. Okay. This is why I wanted to demonstrate what I'm doing. Our long option has increased from 655 to 884. Okay. So we let the stock move up. We've made money on this trade. So let's say you've got 3 contracts on. Sell 2 of them. Take some profits. You might leave that 1 contract on, then come out here and notice that these options that were out here, out of the money, have all of a sudden went up dramatically in price. So instead of selling something for $1.50, whatever, like what we did here, I think we sold that one, something in here, they've increased in value. So we can move farther away from the money. We're now up here at 45 rather than 43, and we're selling that 30 strike delta and we're collecting more money for it. Okay, so then we sell that trade, and that's giving us that better return in the position, potential return in the position, and hedging that overall trade. If you have a 10 contract trade, sell half, hedge half. You see where I'm going here? So that gives you the opportunity to stay with that position, allow both sides of this trade to potentially make you money if the stock continues to move in its trend. And the worst case scenario here, if it continues to move up, I'm going to say, the worst case scenario here at 45 is the stock keeps going up to 45. You get called away at 45. You have $10 profit here in your long position, minus your cost, and you collected money here for someone to have the right to take it from you $10 higher. That's the worst case if it continues to go up. You make money. If the stock moves down, what could happen here? If the stock fails, starts moving down, will you close this trade? But before you do that, you turn this into a debit spread. Excuse me, a credit spread. You buy that option right here. So we've sold this one, we're buying this one here. Now the stock is falling back. These are deteriorating toward earnings. Toward expiration, and these make you money while the stock is pulling back or consolidating. According to price action, I would say more instead of market condition. Art, on an individual trade, I would say according to price action. We all know stocks have that movement pattern, right? They move up, they pull back. They move up, they pull back. They move up, they consolidate. They move up, they pull back. And so we allow them to move, and then we take advantage. Yeah, that's what I thought what you meant. We take advantage of that natural price movement of the stock to make or add to or enhance the potential trade, the profit in the position. Okay, so now considering the overall portfolio that I was just talking about, all we want to do, if we're looking at, let's say we have 20 positions, and we don't really have any hedges on those positions, we've got a bunch of stock trades or whatever, we just want to hedge the overall portfolio. That's where we're going to go into, and we're going to add up our delta positions of everything, and Thinkorswim does that automatically. Adds up your total delta position, and then we look to reduce that delta position by putting on negative deltas to hedge the market. Positive deltas are going to improve. Positive deltas will go up when the market's going up. Negative deltas go down. Same thing is true. Positive deltas when the market is falling will fall. Your negative deltas will go up. So all we're doing is flattening out that delta position and allowing ourselves to profit and hedge off risk in the market. You can certainly use portfolio hedges, certainly, Don. You can use them at any time. The problem with news events is, well, other than price action, we know when price action is starting to look lower and we can hedge our position. News events, we never know which way they're going to go. So yes, you can, say for example, you've just really got yourself stuck out there. You're super long the market or something like that. You're really nervous about an event. Yes, you can add a hedge to reduce that risk. Okay. And RWO members have seen me do this as well. We hold a longer term position. We have to hold through earnings, right? If we're going to hold longer term. So in that situation, let's say, I don't know, anybody know who's reporting next week? If we look at charts, let's, yeah, I'm just for giggles, I'm going to use Facebook here. Okay. Because we know Facebook has already reported. EA might work really well. Let's look at EA. Yeah, okay. Let's look at EA. So let's say I was in a longer position. I'm in this April contract here on, and I bought it when it was about 70 deltas. Here, I need to get rid of that. Go to my open interest. Come on. There we go. Go to my open interest. Obviously, I wouldn't be in this trade. There's no open interest in this position. It's possible, too. It could be just the paper trade not showing stuff correctly right now on the weekend. But let's just, assume that I'm in this position. Now, if I'm in this position on Facebook and I'm up significantly in the trade, significant enough that, and I'm confident in Facebook, I think it's going to go up. I feel pretty good about it, and I have a nice profit in the trade. So let's say I'm looking at this position and I've got, let's say I've got $500 or something in the trade. I've made $500 on the trade. It's still a relatively small position, so I'm up. Now, I could choose to just take the profit and walk away, wait for the earnings event. But I want to hold this. I believe it's going to go higher. So what could I do to mitigate the risk of earnings? So what I would probably do in a circumstance like that is I would come out here. February, you can see, if you look right here, options on money are showing that implied volatility change. We're up here at 86% implied volatility. The February still have a pretty high volatility rank. But if I use the March, notice that there's almost very little change in the volatility on those options. Okay. So what I might do is I might come over here. I have a profit in the trade already. $500 profit in the trade. I may look at an option like here and buy this option. It's going to cost me $278 to buy that option. But what it also does is it gives me a guarantee that I'm out of the trade at 85. If the stock falls, I get out of the trade. I can exercise this option, sell my contracts for 85. Okay, so I'm locking in a stop loss. I'm locking in a perfect stop loss. The market can't gap through these. Okay, like they do a normal stop loss. So I might protect it that way with a trade. So I'm willing to give up some of the profit to buy the insurance. Okay, two scenarios. Stock does just exactly what I had hoped it was. I was bullish on the chart. Stock moves up on the earnings report, looks real good. First thing I do right after the report is I come over here and I buy back this option or sell this option. I close this trade. Okay. Now I'm going to take a loss in that position, right? This is going to lose some money. But because I took an option that didn't have a big decay of implied volatility, I can get out of this trade pretty simply, unless it just really, if it flies up a lot, let's say it just flies up a lot, okay, and this loses 50%. So I've spent $140. I've spent $140 of my 500 profit in this trade to insure this position, okay? So it cost me $140 on the trade. That's what I lost on that position. But if the stock soars, my long position, my April long position, is going to be soaring up as well. Okay, so it offsets this loss here. But I protected the downside by picking up that put option. Okay? And I try to avoid the big implied volatility, because when I get that big implied volatility, that volatility crush can change the prices of the options dramatically. Okay, so I want to avoid that big implied volatility option, those really short term. I'm going to go to here. I won't have as much volatility issue with it. I can easily get over there and close that trade. It's going to cost me something if I'm right, but I had enough profit in the trade to make that worthwhile. I get out of the position and I'm in good shape. Okay, making some sense? Now I know this is kind of a heavy subject, guys, and I know this can be a little bit that subject that just makes you go, I'm never going to get this stuff. Okay? But I don't want you to feel that way. What I want you to feel is that is options are there to help you reduce the risk of a trade, not just pure speculation, reducing the risk of the trade and potentially enhancing the potential profits of the outcome. Okay? That's what we want to do in a trade. We want to give ourselves that opportunity to enhance the position and work with the, so we can sleep at night. We don't have to worry about it so much. Well, no, Kimberly, I can do it on a put too. I just explained calls. People understand calls a little bit easier, but I can do the same trade on a put. If I believe, um, if I believe EA is going to go lower, I'm going to be buying a 70 delta put option. Okay. And if I want to lower the risk in the trade, I can do the same thing here. I could sell a 30 delta option out here to lower my risk in the trade. Instead of $10 risk, I've got $8 risk. And I can do the same legging into the position. If the stock falls, I can let it fall and then sell that put option to enhance the position. Okay, so it doesn't have to be calls. It can be done with puts. Very easily. It's the same mechanics. Okay, but please don't just push this to the side and say, I never need to. That's nothing. If you're into options at all, please understand it's perfectly acceptable if all you want to do is trade long calls and long puts. Okay, but if you want to find out how you can hedge those trades and actually enhance the profits of those trades, you need to be looking at these hedging methods and understanding that delta to get you where you need to go in those trades. Okay, how you can reduce the risk of your position. And that's what I'm about. I want to have enough risk, but I don't want to have so much don't feel comfortable in the position. And if I can reduce the risk or even enhance the profitability of a trade by using some of these hedging strategies, end result, you make more money. And that's what I'm all about. Brokers are always different. What they can do different things. Kimberly, call your broker. I'm not sure. It's probably because I know some brokers have separated out into 5 or 6 levels. My Thinkorswim, if you're a Thinkorswim, I think it's a level 3. Level 3 is going to give you spread trading ability. I think everyone should have the ability to do spread trades. Okay. So with that, everyone, let's just one more time remember that what we're trying to do is we're trying to enhance positions. We're trying to find ways that we can hedge, which is really nothing different than like I said, the most common hedge is just a stop loss order. We're hedging our risk. So all we're doing is looking for other methods to also reduce the risk of a trade and potentially bring us better returns overall. Okay. Yes, she was, Francis. If I buy leaps and when I buy leaps, yes. I'm almost always selling short-term calls against those leaps, hedging the trade. Al, if you're trying to hedge a long position, if you buy a Delta 30 call, you're just adding risk to the trade. You're not hedging anything. You're just buying another right to buy the stock at that higher price. Think about the rights and obligations. If you buy the 70 put, or you're really getting confused here. If I'm buying MU, I'm going to buy the in the money. Okay, in the money 70 to 80 delta position to enter that trade. If I'm going to hedge the position, I'm going to allow the stock to move up, and then I'm going to sell the out of the money with a delta somewhere around 30 deltas. Sell. This is the buy position. We always buy options somewhere between 70 and 80 deltas. We sell options around 30 deltas. One's in the money, one is out of the money. Now, you're welcome. You're welcome. So everyone, hey, I want to wish you all a great day, great afternoon. I know this is kind of a heavy subject, but I think it's really timely. If the market starts to roll over, we want to have ways that we can protect ourselves. If the market does start to roll over, ways that we can reduce our risk in the market. Okay, so we want to be a little bit careful with what we're doing right now. We're kind of extended here in the market. We know earnings and trade deal with China would certainly probably make the market just rise like crazy, but the chances of a pullback are growing. So we want to know how to manage these trades to protect ourselves in case those things do happen. Okay, so learning some of these strategies is really critical, and we can continue to reinforce this during the week if you guys want. And hopefully now you understand a little bit more about why I do what I do when I say I'm selling a call against this position, because I'm really trying to reduce the risk in the trade and hedge the position and maybe enhance the overall profit of the trade. Okay. Yeah, coach, you could certainly do that. 25 deltas. You certainly could. Anything under that, it may not be worth much at 25 deltas. But here's something I would say about a covered call, coach. Never sell a call unless you're willing to give up the stock. Just don't do it. If you're not willing to give up the stock, if you've decided you're dyed in the wool, there's never a reason that you're ever going to give up that stock. Don't sell any calls against it. Because you don't know, it could gap and you get called away and then you're disappointed in the trade. Okay. So never sell a covered call if you're not willing to give up the stock. Because if you're not willing to give up the stock, what's going to happen if the stock continues to rise? Now you're going to buy back that option. You're going to lose money on that option. You didn't help your trade. You made it worse. You lost money in that position. So be willing to let the stock go, or don't sell the call. Okay. Yeah, and I would agree with what Mike just put in there. If you never want to sell that call position or stock position, then use a bull put spread. Use a bull put spread to bring in premium and let the stock continue to run up. Awesome. Hey, thank you guys. Have a great weekend. I appreciate you being here a ton. Take care of yourselves, and we'll see you right back here Monday morning, and hopefully for some more profits this week. Everyone take care. Do something fun. Eat some pie. We'll see you on Monday. Have a good one.